Hello everyone and welcome. My name is Scott Schwartz. I am with Never Too Much Money. That's my company name, where we teach people how to reverse engineer banks and the wealthy to become their own virtual banker. Now, in today's presentation, we're going to talk specifically about reverse engineering the wealthy. And let me go ahead and share my screen with you. So when it comes to reverse engineering the wealthy, what we're going to be covering today is how you can legally and ethically deduct fixed expenses that you no doubt today are considering to be personal expenses, like your housing maintenance, utilities, auto expenses, interest, and many, many more things. Right now, what do? We just pay for those things, figuring there's no way around it, there's no benefit we can get back from that money that has been spent. When actually we can legally and ethically tax deduct those as business expenses. Not today, but with a particular method of business structuring. And we'll go through one example of how one business owner in particular doubled her money, increased her net income by 100% without changing anything but her business structure. No additional clients. She did not increase her prices. All she did was to change her business structure. Now, before getting into the nuts and bolts of just how that works, let me very, very briefly give you an overview of my financial history. I have been bankrupt. I have been on food stamps. I had to short sell my house after a divorce, and I even participated in one of those medical experiments where they inject you with an unapproved medication. You stay overnight in their facilities so they can monitor your reaction to it as a part of the FDA approval process. Why did I do that? Because at that time I felt the most marketable thing I had to sell was my health. That is how bad my finances were at that moment in time for several reasons that I'm not going to get into. But I had a decision to make. That kind of background, which at first was holding me back from becoming a professional in helping people with their finances. I had a conversation with a friend of mine about feeling that I was unqualified due to my personal financial history to help others with their finances. And here's the question he asked me. Who would someone rather learn from? Some trust fund baby who was born into wealth, never faced financial adversity of any kind, or would they rather learn from someone who has been at the bottom and worked their way up? Who would be the more believable? Who would be the one they would be more apt to listen to with that kind of personal background? So I made the decision then that that was going to be my superpower rather than my curse. And from that, this method of recycling money was born, where we can spend and save and grow the same dollars to spend them, save them, and grow them all over again. And that's what the Never Too Much Money business is all about. But I'm only going to be talking today about one aspect of my business. And it came out of this question. Because to be a true financial professional, my vision was that I wanted to show my clients the money. Whereas most financial advisors will say, hey, if you write me a check, if you give me this much, then I'll put it in this fund, in this investment, and get you X%. Wrong question. In my mind, the responsibility of a financial professional is not to ask you how much are you going to put into this, but rather to provide you the money to put into this, to provide you the fuel to put in the vehicle that's going to take you to where you want to go. So I have a few ways that I do that to provide my prospects, my clients, money that will fuel investment. Out of that came reverse engineering the wealthy. One particular approach that helps to provide you the best possible tax deductions, legal protection, asset protections, and this comes from John D. Rockefeller. That's who we're reverse engineering, is the first millionaire, first billionaire in the United States. His thing, remember the acronym ONCE, own nothing, control everything. How is it that he was able to own nothing yet maintain control over everything in his business? In her book, The Millionaire Maker, Laura Langemeyer said, if you want to be a millionaire, you need to act like one. Most wealthy people I know have multiple corporations and trusts as well as charities. The purpose being maximizing tax strategies, legal protection, asset protection. Exactly what we're talking about here today, as well as other things. So you notice she says multiple corporations and trusts and charities. In fact, John D. Rockefeller had over 140 different legal entities that he leveraged in his business to accomplish those purposes. When you tell someone that you're going into business, that you're an entrepreneur, they'll give you advice that, oh, you should be a C Corp, oh, you should be an S Corp, oh, you should be an LLC, and there's certainly many more than what you see on the screen there now. Wrong question. The question isn't which one should you be. The question is, what structure should you have? Sad to say, many people build their roof before they build their structure, their foundation. They think only of what's going to face the public without having strength underneath it. And because of that, I've partnered with a company called Pratt & Lefevre Management Accountants, and you see the benefits on the screen there for you. I'm not going to just read slides here, but they're a group of professionals that represents all aspects of tax deductions, legal protection, and asset protection for small entrepreneurs, helping to take the same value that large corporations have by hiring on high-powered attorneys and accountants and so on, and bringing them together under one roof, making them available for the little guy. So what we're going to briefly cover here, first, what does it mean to file your business versus structuring your business? Just what do we mean by structuring? Quite frankly, you can file your business very easily. You can go to your Secretary of State's website, and for very low cost, perhaps even no cost, depending on your state, you can register as a corporation, as an LLC, as whatever legal entity you might choose. But is that the end of it? Is that all you have to do? That's all that Secretary of State's website will help you to do. But the real question is, what will an IRS auditor say? When you might be audited, they'll look for your operating agreement, your bylaws, because underlying that legal entity that you've chosen are legal requirements. Their question is, where are your meeting minutes? Are you holding regular board meetings? Who are your board members? Who are your shareholders? How are your board members appointed? Are you operating as required? So there's more needed than just filing, having a sheet of paper that says, I am John Doe LLC or John Doe Incorporated. The question in the mind of an auditor is, are you operating as the entity under which you have filed? Or are you maybe just an alter ego or a hobby business, where I may say I'm John Doe LLC, but really I'm operating just as John Doe. Well, then what about those tax deductions you've been taking under that entity? What will an auditor say if they find you've not been operating as required? That's where business structuring comes in. A business that is structured will have the necessary documentation that will back your paperwork, that you are operating as a corporation, as an LLC, and so on. It will greatly also reduce your risk of being audited, and I'll give you an example of that. There's a farmer. He decides to open up a second business, a dairy farm. 7 years later, he's audited. IRS auditor says that he has not shown a profit for 7 years. Therefore, he owes the IRS back taxes $93,000. Farmer writes out a check, $93,000 to the IRS, and then turns around and sues the IRS to get his money back. And he wins. Can you imagine suing the IRS and winning? How did that happen? Well, he had a properly structured business. He was operating as required. And because of that, because of having all his paperwork that showed how his board of directors was elected, how he was appointed as the chairman of the board, how they have been having regular meetings, taking the minutes of the meetings that document all the necessary operations of his business entities, he was able to show his business is fully structured. And the key is it showed that he had a profit motive. And the law did not state that a business had to show a profit, states it had to show a profit motive. Therefore, he won his lawsuit, and the IRS paid him his $93,000 back. Now, let's just hit an overview of some of these different legal entities. High level, what we're doing is looking at the strengths, basic weaknesses of each, because what we want to do is capitalize on those strengths while reducing those weaknesses. The first is a sole proprietorship, and there is no liability protection with a sole proprietorship. You are the business, and the business is you. If someone sues your business, they can go after your personal assets, such as your home, your vehicle, whatever. There is no distinction. There are also minimal tax advantages, and it's the most likely category to be audited. One strength of it, it's very simple. You just decide to go into business under your own name. The next is a limited liability company, an LLC. Some will say that you can have two types of LLCs, a single member LLC or a multi-member LLC. Whether that's appropriate or not, remember we want to please that auditor's opinion of if it's possible for a single person to be a company. Remember, the C in LLC stands for company. Can, by definition, one person be a company? That opens up big problems. But one strength of the LLC is it's a pass-through entity, which means there's no double taxation. You won't be taxed as a business and then as an individual based on the money that you take out of that business. That's a good thing. There's also very easy management requirements, but one of the weaknesses is that you're limited on the write-offs you can claim. For example, insurance, interest are items that you cannot claim as tax-deductible expenses. An S corporation. S stands for small business. Many small business owners then therefore jump to the conclusion, hey, this is made just for me. This is the best choice. And that is not always the case. In fact, it's often not the case. One strength is it does give you the corporate veil of protection. You as an individual are distinct from you as a corporation, but there are rigorous management requirements. One of the weaknesses, to give you an example, is the fact that you must pay yourself a commensurate salary relative to your industry, your job title in your area. So let's say you are the CEO of a coaching company and you decide to save yourself on taxes. You are going to pay yourself a salary of $1 a year. The auditor will say, wait a second, you have to pay yourself a commensurate salary based on your industry and your title. And in your local area, other CEOs of other coaching corporations are paying themselves a salary of X, a range of salaries that you have to be in. So therefore, and this is what happened to the dairy farmer, the IRS told him, you have to go back to when your corporation was formed, pay yourself back salary so that then you can pay us the taxes on that salary. Very dangerous position to be in, of course, to mess with that from the IRS's standpoint. S corporations have many limitations and a lot of red tape to work with as well. A C corporation, C stands for classic. It's the traditional type of corporation. You have some of the same advantages and weaknesses, but not all. You do have the corporate veil of protection, that's good. It is subject to double taxation. You can be taxed both as a company and as an individual. There's rigorous management requirements, but a couple of strengths are easy in and out of funds, and you can take write-offs of some of those same items that were limitations under other entities such as insurance premiums and interest. One more we'll look at is a family trust. This is not a business entity, but it's still a key part of our strategy. It gives you arm's length distancing between yourself and the company. So it's a key part of owning nothing, yet controlling everything. You don't own other entities, your trust does, yet you control the trust. You instruct the trust on how it is supposed to act. One limitation of a trust that I'll mention is if you were to die and your assets, including your business, go into probate, one of the requirements is that all operations of your business must halt. That includes accounts receivables. Even if your business still has money coming in, your surviving family members would have no access to it for as long as your business is in probate. So it will just sit there under the court's control. It is taxed at the highest tax rate of all. It does, though, provide excellent liability protection because of that arm's length distancing. And it's a favorite of estate planners because it provides for painless business succession. How will you pass your business on to your kids, to your favorite charity, however you want it to move? How is it then that you build your business strategically? Here's a key slide. Look at the 4 different components around those arrows. Of those 4 components, the management component, that's you. You know your business. You know how you want your business to be structured, what you want it to do for you. But you know you need help. You need a CPA or an accountant. If you go to a CPA and you ask him for advice, how should I set up my company? What's he going to say? He's going to say, I'm so glad you asked. I've got just the thing that's going to give you the best tax deductions you can find anywhere. And that sounds great. Then you go to an attorney. You know you need an attorney, and you ask him for his advice. How should I structure my business? And the attorney will say, I'm so glad you asked. I can help you. I have the best strategies, the best processes to provide legal protection from frivolous lawsuits, protect your assets. Great. Then you ask an estate planner. how should I structure my business? He'll say, I can help you with that. I know the best strategies for passing your business on to your kids after you retire, after you die, seamlessly and with minimal taxes. All three of those responses are correct. All three of them are very incomplete. Why is that? Well, they were only looking from their perspective of expertise. You need all of those things. You need tax strategies, you need legal protection, you need asset protection. What I want you to do is picture this. Instead of approaching each of those three professionals individually, this time you invite them to join you at the same conference room table. And now the four professionals, you and those other three experts, are going to learn and discuss and find the solutions, a balanced solution that will take all areas of those expertise into account. That would provide you what you want, what you're looking for, wouldn't it? To have them all together reading from the same book, following the same general guidelines so that each area of expertise is taken into consideration. That is a structured approach. Now, how does it work? How is it that we can legally and ethically deduct our housing maintenance, utilities, auto expense, interest, and much more as business deductions and have those tax benefits, have that legal and asset protection? Here's an example. Tony Densing. She inherited a business, ran it as a sole proprietor for 10 years, and paid about $10,000 a year in taxes. Then she upgraded to an S Corp, and now she got back $1,000. So an $11,000 difference. Rather than paying 10, she is getting back 1,000, and she was ecstatic. When she was approached about this idea of business structuring, what do you suppose her reaction was? Oh, I've done that. I love it. It's great. It put $11,000 a year in my pocket. No, she hadn't done that. She built the roof, and the roof gave her some protection, but she wasn't structured. Later, she structured her business. Her next tax return was $20,000. So now we're talking a $30,000 difference. So let's make a couple of assumptions here and do some very basic math. Most common tax bracket is 25%. So if she was paying $10,000 per year, let's assume that she was making $40,000. Okay, a fair assumption? Probably right in that range there. So from $40,000 in income, she pays $10,000 in taxes, she nets $30,000. Now after business structuring, she gets back $20,000. So from that $40,000 income, add $20,000 to it, that's $60,000. She doubled her money. 100% increase on her net take-home income from this one change. No additional clients, no increase in prices, just business structuring. Doubled her money. Now, I am not going to guarantee that you will double your money by doing this. I will make you this guarantee. I guarantee that if you reach out to me and we start digging a little deeper on how this business structuring can work for your business, that me and my partners at Pratt & Lefevre will find the most business deductions that we possibly can for you. And remember, the whole purpose behind this is for me to show you the money. money that I can then use other approaches to be a force multiplier. Again, that's not the focus of this conversation. I want to make an invitation to you to learn more about the business structuring. I am going to put my email address in the chat so that you have it there, scott@nevertoomuchmoney.com. And for the sake of those who will be watching this on the recording, I am going to go back to the slides so that there you've got my email address again, scott@nevertoomuchmoney.com. Also my website, nevertoomuchmoney.com. There you will be able to schedule a call with me so that we can talk and drill down deeper to find what we can do to get you the most bang for your buck, the best possible tax strategies, legal protection, and asset protection that we can. Thank you so much for joining me. I am going to stop the recording and open this up for questions.